welcome once again to Intelligent Investment Today. This is a podcast where we explore the timeless principles of value investing. The ideas that help investors navigate markets in both good times and bad. And today we turn our attention to a company that's been something of a cornerstone in the world of long-term investing. A business so familiar that it is often overlooked. A product so simple that it is consumed billions of times each day. And yet beneath that simplicity lies one of the most powerful business models ever created. Today we're going to analyse the Coca-Cola Company through a value investing lens. We will explore why it's considered to be such an understandable business, why it has developed such a deep and enduring competitive moat, and importantly, why despite all of these strengths, it is not necessarily cheap, and certainly not what a value investor would describe as being a screaming bargain. Because in investing, quality and price are not the same thing, and even the best businesses must still be judged on valuation. So, as ever, sit back, tune in, and get ready to take on board another lesson in value investing as inspired by Benjamin Graham. So to begin, let's consider what makes a business easy to understand. For this idea is central to value investing and is emphasised repeatedly by figures such as Warren Buffett. He often speaks about investing within one's own circle of competence. In other words, focusing on businesses whose economics you can clearly grasp. And few companies exemplify this better than Coca-Cola. At its core, Coca-Cola produces and sells beverages, primarily non-alcoholic branded drinks. There is no complex technology underpinning the business, no rapid cycles of innovation that can render products obsolete, no need to forecast entirely new categories of demand. The product is simple, the demand is consistent, and the business model is remarkably straightforward. Coca-Cola produces syrup concentrates, which are then sold to bottling partners, who manufacture, distribute, and sell the finished drinks. This structure allows the company to remain relatively asset-light, while focusing on branding, marketing, and global strategy. From a value investing perspective, this simplicity is a major advantage. It reduces uncertainty, it makes forecasting more manageable, and it allows investors to form a clearer view of long-term earnings power. But simplicity alone does not create value. What truly sets Coca-Cola apart is its competitive moat. And this is where the business becomes particularly interesting. One of the most powerful elements of Coca-Cola's moat is its brand. This is not simply a well-known name. It is one of the most recognised brands in the world. Across continents, cultures, and generations, Coca-Cola represents something familiar, something reliable, something consistent. Consumers know what they're getting, and that familiarity creates trust. In many cases, when a consumer is presented with a choice, they do not analyse ingredients or compare prices in detail. They choose what they recognise, what they have experienced before. And this behavioural tendency is incredibly valuable because it creates a form of demand that is not easily disrupted. Competitors can try to replicate the product. They can even produce similar beverages. But replicating decades of brand equity is far more difficult. And that is where Coca-Cola's advantage lies. But the moat extends beyond branding. Distribution is equally critical. And Coca-Cola has built one of the most extensive distribution networks in existence. Its products are available almost anywhere, from major supermarkets to small local shops, from restaurants to vending machines, from urban centres to remote regions. This level of reach creates a powerful advantage, because even if a competitor develops a comparable product, getting it into the same number of locations is an enormous challenge. And distribution, once established at this scale, becomes self-reinforcing. Retailers want to stock what sells, and consumers buy what is available. Coca-Cola sits at the centre of that dynamic. There is also the element of habit. Coca-Cola is not a product that consumers purchase once. It is consumed repeatedly, often daily. It becomes part of routines, part of social occasions, part of cultural norms. And this habitual consumption leads to recurring revenue. And recurring revenue is one of the most desirable characteristics in any business, for it provides predictability, stability, and a degree of resilience during economic fluctuations. Now, it is important to recognise that no business is without challenges. Consumer preferences are changing. There is an increasing awareness of health and nutrition. Sugar consumption, in particular, has come under enormous scrutiny, and this presents a potential headwind. But what is notable is Coca-Cola's ability to adapt. It has expanded into low and zero sugar alternatives. It has diversified its product range, invested in new categories, and in doing so, it has demonstrated that its strength is not limited to any single product. And this adaptability helps to reinforce its moat, because it shows that the business can evolve without losing its core advantages. Now, having explored the strengths of the business, we arrive at a critical point: valuation. Because from a value investing perspective, no analysis is complete without considering price. And this is where it becomes important to be very clear. The Coca-Cola Company is not cheap. It is not a distressed business. It is not overlooked or ignored by the market. Quite the opposite. It is widely recognised as a high-quality company. And as a result, it often trades at a premium valuation. Investors are willing to pay for stability, predictability, brand strength, and consistent cash flows. And that willingness drives prices ever higher, which means that in many cases, Coca-Cola is not a screaming bargain. You are not buying it at a deep discount to intrinsic value. You're often paying a fair price, or at times a full price, for a very good business. And this creates an important distinction, because value investing is not simply about buying great companies. It is about buying them at the right price. This is where the teachings of Benjamin Graham remain highly relevant. The concept of margin of safety, the idea that you should build a buffer into your investment decisions, a cushion against uncertainty. But when a company is priced at a premium, that margin of safety becomes smaller. And with a smaller margin of safety comes greater sensitivity to changes in expectations. If growth slows, if margins compress, if external conditions shift, the valuation may adjust. And that can impact returns. Now, this does not mean that Coca-Cola is a poor investment. Far from it. It may still offer attractive long-term returns, particularly for those investors seeking stability and income. But it does mean that expectations must be realistic. You are unlikely to achieve extraordinary returns from huge business expansion. The gains, if they come, are more likely to be driven by things like steady earnings growth, dividends, and long-term compounding. And this brings us to the broader lesson. There is a difference between a great business and a great investment. Coca-Cola is almost universally regarded as a great business. But whether it is a great investment depends on the price you pay. And that requires discipline. It requires patience. A willingness to wait for more attractive entry points. Or an acceptance that you're paying for quality. And adjusting expectations accordingly. This is something that Warren Buffett himself has navigated. While he's ultimately invested heavily in Coca-Cola over the years, he did so at times when valuation was more favourable. And that decision, combining quality with a reasonable price, contributed significantly to the long-term success of that investment. For today's investor, the lesson is similar. Recognise the quality, understand the moat, appreciate the simplicity, but do not ignore the price. Because price is what determines return. Not admiration, not familiarity, not even business excellence alone. As we begin to draw this discussion to a close, it is worth reflecting on what Coca-Cola represents. It represents clarity, a business that is easy to understand. It represents durability, a company that has endured for decades. And it represents competitive strength, a moat built on brand, distribution and habit. But it also represents a reminder that even the best businesses are not always bargains, and that value investing requires more than identifying quality. It requires a discipline in valuation. Because ultimately, the goal is not simply to own great companies. It is to generate satisfactory returns with controlled risk. And it means always asking the same question. Not just, is this a good business? But, is this a good investment at this price? And on that, we draw this edition of Intelligent Investment Today to a close. If you found the episode worthwhile, then you know what you can do. Add to playlist or subscribe so you'll be reminded whenever a new edition lands. The podcast is also now available as a Substack newsletter and can be found at substack.com under the name @IIT Podcast. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.